Debt is sold to you as a ladder. It is not. In the real world, debt is the leash that keeps you working while someone else rearranges the rules in their favor. And here is the part nobody wants to say out loud. In 2026, the people who are winning with debt are not the people who are bad with money. They are the people with assets, cash flow, leverage, and timing. Everyone else is simply financing their own trap. This is not financial advice. This is financial education, and it is going to sound uncomfortable because it should. Most adults in the United States, the United Kingdom, Canada, Australia, everywhere with a modern financial system were trained the same way. Work hard, save money, get a credit card, take out a loan when life gets expensive, buy a house when you are ready, get a degree so you can earn more. Then, someday, you will be safe. That story died quietly between the inflation years and the housing years and the AI years. You were told rates will come down, sure, on paper. But your purchasing power did not spring back like a rubber band. Meanwhile, housing prices detached from wages so far that a whole generation simply accepted renting as their permanent lifestyle. Renting is not a phase, it is a business model. So let us tackle the central lie. Is debt the road to financial freedom? Debt can look like freedom when you are young, when asset prices are rising, when the job market is still forgiving, and when you believe that paying interest is just the price of progress. But debt is not progress. Debt is a transfer mechanism. It decides who gets to keep the upside and who absorbs the downside. And in 2026, the downside is not theoretical. It is happening right now, month after month, paycheck after paycheck, mortgage after mortgage, rent after rent. Here is what you will learn and why it matters immediately in 2026. You will learn the difference between debt that buys cash flow and debt that buys depreciation. You will learn why the same financial tools feel totally different depending on whether you own assets or only liabilities. You will learn how central bank policy, interest rate cycles, and global debt dynamics are shaping your cost of living while rewarding the people who already have balance sheet power. And you will learn why the passive income dream on social media is often built on the exact same financial math that traps you in the real world. But first, you have to face a truth that feels like betrayal because you were taught the opposite your entire life. The person who profits from your debt is usually not the person who is borrowing it. They are not even subtle about it. Picture a 32-year-old nurse named David. He works nights. He keeps his credit score decent. He has a small emergency fund and it feels like a shield. In 2020, he watched prices rise and told himself it would settle. Then in 2022, his rent jumped again. Then his car repairs hit like a meteor. He took out a loan for the repairs because the alternative was missing work. At the time, it felt like survival. Now, in 2026, he is still paying. Not just the interest, the stress interest, the opportunity cost interest, the sleep schedule interest. And here is the part that makes you sick. David does not own the loan. He pays it. The institution that owns the loan created its business model around expecting people like David to keep paying. Debt is a market. You are the product. Now compare that to another person. A landlord with cash reserves, stable financing, and a portfolio. He takes out debt too, but he uses it to buy something that produces income. If the property covers the payment, the debt becomes a tool. If the property does not cover it, it becomes a leak. So the question is not, is debt good or bad? The question is, debt for what, and debt in whose hands? And once you see that, you stop asking the wrong question, and you start noticing what is really going on. First, content section. The timing game is everything, and the mainstream advice hides the timing on purpose. In almost every finance video you have ever watched, the storyteller says, get leverage, buy assets, stay disciplined. That advice can be correct in theory, but it becomes dangerous when you are living inside a different reality than the one they assumed. 2026 is the year of timing as policy. The Federal Reserve does not just set rates, it changes your entire economy's gravity. When they tighten, borrowing becomes expensive. When they loosen, borrowing becomes easier. But the real transfer happens when asset prices react faster than wages. This is why your friends feel like they are drowning even while headlines talk about stabilization. According to Federal Reserve data, real median household income has not fully recovered to the trend it was on before inflation took its first bite. And even when headline inflation cools, the damage to your budget can remain because the cost of key items stays elevated: housing, insurance, healthcare, childcare, and energy. Now bring AI into the picture. In 2020, a lot of people heard the advice: learn to code, learn a new skill, become future-proof. In 2026, that advice is a punchline because generative AI can produce code, documentation, and designs at a speed that beats most entry-level humans. What that means is brutal. If your income depends on tasks that AI can replace, your negotiating power collapses, your wage growth slows, and your ability to service debt declines. So debt becomes a trap at the same moment you lose leverage at work. That is not a coincidence. That is how cycles punish the middle. A pattern interrupt you should not ignore. The middle-class job that used to buffer you is shrinking. And the buffer is your ability to pay more than you spend, to refinance, to take on extra obligations. When that buffer fails, debt stops being leverage and starts being forced labor. In the last decade, the wealthiest people did not avoid debt. They used debt strategically while your advice told you to avoid it. They borrowed cheaply against assets. They paid themselves in ways that create capital gains rather than wages. They placed themselves in the position where inflation and rate cycles could benefit them, not harm them. While you were told to pay down credit cards, they were often taking loans against their portfolios at interest rates that were lower than the returns of the assets those loans were attached to. You might think that sounds impossible. It is not. It is exactly what a bank does when a client has collateral. The entire system is designed to treat people with assets as low-risk borrowers. Everyone else is treated as unpredictable. That is not justice. That is risk pricing. And here is where the story gets truly ugly. In 2026, global debt is above $300 trillion. That number is not a guess. It is the sum of governments, corporations, and households across the world, adding up obligations that must be rolled, refinanced, or repriced over time. When debt markets roll over under stress, interest costs rise, and asset values can swing violently. When that happens, the people with liquidity buy. The people without liquidity sell. In other words, crises are not disasters for the wealthy. They are procurement events. Now connect this to debt as a road to freedom. If debt is a road, then the question is who built the road and who gets to choose the destination. The wealthy are not driving into a random storm. They are driving through predictable weather because they own the maps. And you are still being told to carry an umbrella that you bought with credit. But that is not even the worst part. Because even when debt is used correctly, the system can still extract you. Second content section. When debt is framed as freedom, it is usually because it is feeding someone else's balance sheet. Let's talk about the cultural narrative. Debt is normalized by entertainment. People buy cars they cannot afford. People buy designer clothes on credit cards. People take out loans for lifestyle upgrades and call it progress. And then, when the payments become unbearable, they call themselves victims or failures. You were not a failure. You were targeted. In 2026, the targeting is sharper. It is algorithmic. If you have a certain income profile and certain spending habits, you are offered financing terms that keep you just barely afloat. Not enough to get ahead, enough to keep you paying interest. Here is a micro story. Think of a 38-year-old warehouse supervisor named Marcus. His job is stable, but his pay has not risen much. He wants a better life, so he buys a new vehicle financed for years. The monthly payment looks manageable until insurance rates jump, and his utility bills jump, and his car needs another expensive repair. He tries to refinance once. Rates are higher now. He tries again. The bank approves, but only with fees and a higher total cost. He is still paying the same emotional bill, the feeling that he is one emergency away from panic. And while Marcus is doing that, someone else is doing the opposite. A person with multiple properties, diversified investments, and cash reserves borrows against low-risk assets. When they borrow, they can negotiate. When you borrow, you get a standardized contract. So debt is not the road. Debt is a contract that sets your future constraints. Now consider the housing market. In every Western country where housing affordability has collapsed, debt is the engine that keeps transactions alive. But affordability is not only about interest rates, it is about wages compared to asset prices. If house prices rise faster than incomes, then even if rates later drop, the entry point remains unreachable. That means younger people stay locked into renting, and landlords, funded by their own financing structures, capture the rent stream while you pay their debt, and there's your landlord's profit margin. A pattern interrupt. You do not just pay rent, you pay the opportunity cost of not owning. Renting in a high-price environment is wealth transfer disguised as housing. Now look at inflation. People say inflation came down. It did. But real purchasing power does not restore quickly. You can get a lower inflation headline while your wages still lag behind what you need to buy. And your debt interest rate might adjust upward, or your payments might reset on renewals. So even if the rate hikes stop, the damage to you can continue because prices are sticky where it matters. And sticky prices are exactly where debt obligations sit. Now bring in the AI labor disruption. As AI automates tasks, people lose entry-level pathways. The future becomes narrower. When job growth slows for the middle, The pool of people who can afford debt shrinks. And when the pool shrinks, defaults rise, credit terms tighten, and recession risk increases. In that environment, debt can still work for some, but it will not work for everyone. It is not designed to. This is why in 2026, you see a disconnect that feels like a psychological trap. The stock market hits new highs, earnings look strong for companies with pricing power, and wealth concentrates at the top. Meanwhile, average people feel poorer and more stressed. The disconnect is not accidental. It is built on a mechanism. Asset prices rise based on the discount rate and expectation of future cash flows, while labor is slow to reprice. When you do not own assets, you cannot capture that rise. So what happens to your debt? It keeps charging. Now, someone will bring up the famous idea. Well, Warren Buffett held cash and still made huge investments. Or they will cite Robert Kiyosaki-style narratives about debt being good. They will say, the rich use leverage and you should too. But you do not become rich by copying a slogan. You become rich by having the right balance sheet. You become rich by owning assets that generate income or by owning equity that appreciates. Debt is not wealth. Debt is leverage. Leverage can magnify gains or magnify losses. The system makes the magnification asymmetric. It magnifies for those with collateral and income. It crushes those without. And here is where we connect the dots to global policy. When the Fed tightens aggressively, it can raise borrowing costs for everyone, but it can also boost the relative value of dollars compared to other currencies, changing capital flows worldwide. Institutions with access to global funding can rotate into opportunities. People without access are left exposed. Meanwhile, global debt above $300 trillion means the world has to keep rolling obligations. That creates constant refinancing pressure. If rates stay higher for longer, the cost of debt service grows. And when debt service grows, forced selling becomes a common outcome. Forced selling is how the wealthy buy the dip. And if you think that sounds too cynical, ask yourself why the mainstream financial advice always starts with get rich by investing instead of learn how the system captures your downside. The first narrative keeps you optimistic. The second narrative keeps you alert, but you still might be thinking, okay, maybe debt is risky, fair. But is it really that different from saving cash? Let's go darker, because the answer is worse. Third content section. Cash feels safe until you understand what inflation does and what the system does with your cash. A lot of people love the idea of being cash only. They say, I do not trust banks, I do not trust markets, I will just hold money. In the 2026 environment, holding cash can be a psychological comfort, but it is not a guaranteed shield. Cash is losing to inflation when inflation exceeds the interest you earn after taxes. And in an environment where insurance, healthcare, and housing costs can be persistently high, the real cost of living can keep rising even if inflation prints look calmer. So the wealthy do not simply hold cash, they hold assets. They also hold the option to borrow against those assets when times get uncertain. That option matters. Here is the uncomfortable truth. The financial system does not need your trust. It needs your deposits, your wage income, your spending, and your continued participation in credit markets. Banks are not community helpers. They are intermediaries with a business model built around lending. They take in deposits and issue loans. They earn interest spread. In a fractional reserve system, the same deposit base can support multiple rounds of lending. That means your safety is not neutral. It is part of the mechanism by which credit expands. You can feel moral superiority for not being in debt and still be participating. Because even if you avoid loans personally, your employers, consumers, and governments are all using credit. And when the system expands, asset prices respond. When it contracts, your job market responds. Now add central bank policy. The Fed sets the policy rate and influences broader rates. When rates are high, the cost of borrowing rises, but the interest on certain safe instruments can increase too. That can create a temptation to hold cash. But if your real inflation losses continue, you still lose purchasing power. Now, micro story to make this visceral. Imagine a teacher named Rachel. She saved for years and kept her emergency fund in a high-yield account. She felt proud. Then childcare costs surged. Then healthcare premiums rose. Then her city property taxes increased. She did not lose money on paper. Her account balance stayed stable. But her ability to buy the same basket of goods shrank. Her savings became a smaller shield than she expected. This is what real inflation damage looks like in real life. Not the chart, the grocery bill, the insurance renewal, the rent renewal. And then there is the part nobody discusses. Inflation is not just a macro number, it is a redistribution mechanism. It transfers wealth from those with fixed or slowly rising incomes to those with flexible income streams and asset ownership. So when people say debt is bad or debt is good, they ignore the deeper mechanism. You are either positioned to benefit from asset inflation or you are positioned to absorb price increases with wages. Now we bring in crypto, because the story is a perfect example of misdirection. Crypto was marketed as freedom from banks. In practice, by 2026, Institutional players own more crypto than retail does. Regulation tightened in many places, and the liquidity and custody infrastructure mostly favored large participants. Retail investors who believed in decentralization found themselves competing on speed and marketing, while large entities had better execution, better custody, and better access to leverage. So if debt is the leash, crypto became a leash with a new logo, and that brings us back to debt. When people talk about financial freedom, they often confuse freedom with access. Debt provides access to purchases. It does not guarantee freedom. It can become a chain. The wealthy understand this. They use debt when it is a controlled tool, and they avoid debt when it is an uncontrolled risk. So what does controlled tool mean in practice? It means the debt payment is covered by cash flow that is more stable than your income. It means you can refinance if conditions change. It means you do not need to sell your core assets at the worst time. Most people do the opposite. They borrow to buy lifestyle. That lifestyle depreciates. It does not pay you. It costs you. And if their income drops, they cannot service the loan. This is why the same debt can be categorized differently. Debt that buys income-producing assets can become cash flow leverage. Debt that buys depreciating assets becomes bad debt. Here is a pattern interrupt that feels obvious, but most people refuse to see it. In a recession, employment becomes the asset that people lose, but housing, cars, and luxury goods are liabilities when they are financed. So in downturns, the thing you own is less important than the thing that owns you. And now we come to the fourth part, which is where the story becomes truly ugly for the way you have been taught to think about ownership. Fourth content section. Middle-class destruction is not random. It is designed by incentives that protect asset holders. You were told the middle class owns houses, cars, and retirement accounts, but ownership is not binary. It is fractional, it is rented out to banks through monthly payments, it is partially controlled by lenders through covenants, it is partially controlled by markets through interest rate volatility, a cliff you probably never considered. People think their house is their wealth. It can become their debt. Here is why. When you buy a house with a mortgage, you do not receive the benefits fully, and you do not absorb the risks fully until later. Early in the loan, most payments are interest. In the beginning years, the mortgage behaves like a transfer of value to the lender. You are paying rent to the bank with a fancy marketing brochure. Now, as prices rise, you feel wealth because the asset value on paper increases, but the bank still collects the payment. Your equity increases slowly at first, faster later. Then a shock arrives. Maybe rates rise, maybe your job disappears, maybe you get sick, maybe insurance jumps, and homeowners insurance becomes an additional monthly burden. In 2026, this is not a niche problem. Insurance markets in parts of the United States and other regions have been under stress. Premiums rose, coverage got restricted, and policy renewals became unpredictable. So your fixed monthly mortgage is not fixed. Your total housing cost keeps changing, and that is where the middle class gets crushed. Middle class households are highly leveraged relative to their income. They can handle normal life. They cannot handle shocks. A shock in 2026 might look like this. AI reduces demand for your role, your hours drop, then your lease renewal jumps, then your health costs increase. Suddenly, the monthly payments that were manageable become impossible. This is why the useless class debate keeps growing. When AI and automation displace tasks, society is forced to ask how much work is actually needed compared to how many people are trained for those jobs. That is a political and economic choice, and it shapes who gets stability and who gets precarity. Now ask yourself, who has the financial insulation to ride those shocks? Usually the people with diversified assets and cash flow. Usually the people who can borrow against assets without losing their core position. So debt for them is often insurance plus leverage. Debt for you is often a countdown. In 2026, retirement is a second countdown. Social Security's long-term solvency concerns and the ongoing underfunding issues in many pension systems mean people are being told to delay retirement. That increases lifetime income needs and